Good morning. This is Ken Long from Tortoise Capital. Merry Christmas edition of the Weekend Reports. Getting right into it, we have the market still in bull quiet conditions on an annual basis at the high end of neutral. On a 10-day basis, we are still in overbought conditions. The slope of the 50-day moving average and the percent stretch above the 200-day moving average are both highlighted green, meaning they're exceptionally bullish and strong. ADX has now increased to 26.3, so it's over that critical 25 mark in ADX, which is the threshold for a strong trend. We've seen that grow from under 15 to now over 26. If and when it gets above 30, that will be an indication that the bullish move is very mature, and it'll be getting to extremely strong conditions. So we'll watch for that. The ATR percentage is 0.66%. That's as quiet as it has been in the last 180 days. In the ETF2 report, our exposure we're going to see is increased from 70% to 90%, which gives us authority to buy 2 new positions. And that should read DBA, Agriculture, and KRE, Regional Banks. DBA, I just noticed that, sorry. The monthly and quarterly rebalancing is due in a week or so, on or about 1 January. And you can see that I'm using 331, still holding MDY, the Qs, and IWM. In the market health check, you can see the 30-day regression line is very steep and up. And you see the channel. We're right on the regression line lately. Last week was low volume, steady upward movement. Price is better than the 20, better than the 50, better than the 200-day moving average. And you can see the steady improvement in ADX that now has it just above 26. In the Williams percent R10, we remain overbought. From the ETF2 regional report, U.S. small caps continue to dominate, and all of the U.S. indexes are better than any of the internationals. We have moved from 70-30 split to a 90-10 split in terms of asset allocation. Benchmarks systems performing as designed. On the extended world market model, you can see the semiconductors have cooled off a little bit but remain strong. All of the commodity areas are in good posture. Materials and energy in the U.S. sector spiders are continuing to dominate. Weakness in utilities and healthcare in the defensive areas. In the world market model itself, again, starting with the U.S., you can see a little bit of weakness in the Dow. Great strength in small caps, and growth is to be favored over value. A few pockets of strength elsewhere: the general commodity sector, Taiwan and India in Asia, materials and energy in the U.S. sector spiders. Weakness in the treasuries and bonds, China and Singapore, and then anywhere you want to look in Europe. Dollar up is still stronger than dollar down right now. Almost all positive signals in the 100 by 200 crossover indicators, with even the internationals beginning to catch up now. The ETF top 30 from the ETF2 report, you'll see it dominated by commodities and energy. Once more, silver, agriculture, grains, metals and mining, oil equipment, banking, copper, Taiwan oil and gas exploration, and so on. A lot of these you can see on the weekly RSI are greater than 70, indicating that they have really made significant moves higher. In the same way that Williams percent R can remain overbought for long periods of time, so too can the weekly RSI. That's no reason to get out, but it is an indication that we're looking at an exceptional move. The ETF liquidity, these are the top 25 most liquid ETFs on the basis of daily dollars, average daily dollar volume. And highlighted in green are the ones that are exceptionally volatile. So for intraday traders or swing traders, if you're looking for the volatility, you should be looking at Brazil, treasuries, gold miners and oil service, U.S. real estate, and oil. The Dow 30 is at 0.6% ATR percentage, is extremely quiet. You see that's even slightly more quiet, like 10% more quiet than the spiders themselves. Small caps remain at a very useful trading target for me. They're so liquid, and at 1.06%, they are almost double the volatility of SPY and 25% more volatile than the NASDAQ. Taking a quick look at ETF2, or the sometimes known as the Smart Steps report. You've seen those tables before. We'll be adding DBA and KRE because of the increase in recommended theoretical exposure. These are the positions that we're holding right now, and you can see that there's no reason to sell any of them. They're all in the green and positive on the 5-week rate of return. And you can see the current holdings are all favorable since we've bought them. These are updated stops, with the stops in DBA and KRE being based off of Friday's close, but your mileage may vary depending on what your entry is on Monday. That's all from the Tortoise Weekend Report. Wishing you a Merry Christmas to you and yours, and thanks for the support.